We have finally arrived. It is time for real event risk to maybe wake up the financial markets. This is Ilya Spivak, head of global macro here at Tasty Live, and this is Macro Money, where we're going to look at the U.S. CPI report, the inflation figures due out on Wednesday, that may give these markets something to think about and something to trade on. One of the last little bits of critical event risk, frankly, before the end of the year. And the question, of course, is, do they matter? Will anybody care? Now, what we're going to do here is we're going to see what's expected, see why the markets might react this way or that, and then consider what the price action might look like across asset classes. So let's jump right in and take a brief anchoring in expectations. This is what we're looking at here. The headline number expected to tick up 2.7% year on year expected here. That's a little bit of a spicy number, if only in the sense that it represents the second consecutive month that inflation will have gone up. It's, at least at the headline, that is. It's also interesting in that the core reading here, the one that's excluding volatile items like energy and food, which you can see here are not, in any case, a major contributor to inflation. All of it's still sitting in the service sector, so much so that the contribution from goods and energy are actually negative. Those are actually in deflation mode here at a marginal level. But the core level that excludes those things and mainly is tracking that service sector, which of course is the question du jour for Fed officials, that's expected to come in at 3.3% for a third consecutive month. And what that would mean is that we now have not seen deflation or disinflation at the overall level, any kind of decline in inflation of any kind, as it were, since July. And that's notable. So in July, we went up, or in July, we went down, rather, from 3.3 to 3.2%. We hung out there in August. We went back up to 3.3 in September and have stayed there since. So what you see here, if we look at how the core number has performed here, this is actually a more significant wiggle higher than what we saw at the beginning of the year, where this kind of stalled. And of course, at that time, the Fed was all kinds of upset about it. The May meeting of the Federal Open Market Committee, the Fed's steering body, issued a statement at that policy announcement saying there's been a lack of progress on inflation. The very following meeting in June, they slashed the expected number of rate cuts on the menu for this year by 2 rate cuts worth, by 50 basis points. And this now has been arguably a longer stall and with a little bit more upside incline. So does this mean that the Fed is going to rethink what it does next? I mean, the evidence to suggest that maybe they could, on the surface, looks compelling. If we take a look here, what's going on with the shorter term measures of inflation momentum. This is the 3-month change annualized for headline and core. The first 2 bars here, the blue, the red, that's headline. The yellow, the green, that's core. The first one is the 3-month, second one is the 6th for both. And these are higher frequency annualized numbers that the Fed looks at beyond the usual year-on-year numbers to get a sense for where things are going. notice that over the past 4 months, the 3-month rate in headline CPI has been going up. The same can be said for the core. That's the yellow bars there. It's been a little bit better for the 6-month rate. It's been coming down, but for the past 2 months, the headline hasn't really made much of an effort to continue going lower, and that's much more so for the 6-month rate in the core, which ultimately is what we care about more. You can see these green bars aren't exactly falling down very much. So momentum around disinflation is very plainly stalling. But the Fed doesn't seem up in arms. And because it isn't, neither are the markets. If we take a look at expectations for December's policy meeting next week, we can see that 88% probability implied in Fed funds futures says that we're going to have a rate cut from a range of 4.5 to 4 3/4 to 4 1/4 to 4.5 on the Fed funds rate. Now, not only is this a very high level of conviction in markets that the move is going to happen, but if we look at the way that the odds for a December move have evolved here, they are at this point at the highest level in 2 months. So not only are the markets pretty well certain that the Fed is going to cut by another quarter of a percentage point here, they've become more certain in recent weeks. So this move is probably on, and these situations with CPI stalling apparently don't seem to bother anybody. Now, that's maybe to be expected. Here's the latest summary of economic projections from the Fed. That was at that fateful September meeting where they kicked off the rate cut cycle. And it's not difficult to see why the markets would be fairly sanguine about the December move in particular. So consider that when they did this, the outlook called for 100 basis points in cuts this year. If we consider that the rate in September was about 5.3, 5.4, the median between 5.5 and 5 1/4. And what you got there was then a 50 basis point cut. You already did half of the 100 basis points that's implied here. So again, if the median rate is 5.3, as we can see, the Fed sets its targets in a range. You can see that right here. So, and this is of course where we are currently, between 4.5 and 4 3/4. So looking back here, if you expect rates at the end of 2024 to be 4.4 and you started the year at 5.4, that's 100 basis points in cuts. 50 of them got delivered in September, leaving just 2-minute meetings for the rest of the year, November and December. It seems pretty easy then to make the logical leap that each one of those meetings are going to have a 1/4 point cut apiece. Moreover, when Fed Chair Powell spoke after this meeting and was asked directly, what are the next steps, he made the uncharacteristic remark, we'll just look at the SEP, the Summary of Economic Projections. The Fed doesn't generally like to make the SEP out to be some sort of official forecast. It likes to make a big deal out of this is just a collection of expectations from individual policy members, then we average them, and then we take the median, and then we get the central tendency. This is not official Fed gospel. This is just a surveying of Fed officials. That the Fed chair would basically say, well, look at the number, that's what it is. That basically says that we're somewhat on autopilot. And indeed, in November, we got another 25 basis point cut. Now we're just one meeting left for the year, one cut left to satisfy this forecast. So it doesn't look like there's much deviation, or that it would take a terrible sort of mental ingenuity to come up with, we're probably going to get this cut, no matter what the CPI data holds. The larger question is what's going to happen next year. And you can even see in the Fed's storied dot plot here is that there's quite a lot of consensus around what's going to happen for this year. These dots for the individual policymakers are fairly clustered. There's a lot more divergence for what might happen next year. So maybe all of these CPI disinflation stalling cues, maybe they mean something for next year. And maybe that will have an impact. Well, also maybe not. If we look at minutes from November's FOMC meeting, there's a number of bits that stand out. And the way that these minutes typically are set up is the Fed editorializes them, but it gives a sense of how many people held a particular view, so where the consensus is going. So they might say several members said this, and some members said that. A few members said this, most members said that, many this, almost all that. And so these are some of the choice statements speaking to the consensus on the Fed, which has since been endorsed by Fed Chair Powell at the speech that he gave last week in front of the New York Times Deal Book Summit in New York. Many participants noted the volatility of recent economic data and highlighted the importance of focusing on underlying economic trends. That is to say, whereas the Fed was all kinds of flustered by stalling disinflation in the first quarter and in the first half of the year, they're not flustered now. They think we should look through data volatility. Almost all participants judged that through month movements would remain volatile in the data. It's generally consistent with returning back to 2% inflation. So they're very clearly not concerned, even as signs of stalling disinflation look much more ingrained. And finally, just to make the point that we are in fact almost certainly on autopilot here, a large majority of respondents have a modal expectation of a cut at this meeting, that is November, and another equivalent one in December. So autopilot, it seems to be. Now, this is where things get a bit more interesting. We already can see that in the wake of that September meeting where the Fed made all those bets on rate cuts, the markets have decided that things are not quite as likely to evolve as the way the Fed would suggest as they might seem. And so we see that while the outlook for this year, 2024 outlook as implied in Fed funds futures, has been moving in relatively orderly fashion. We can see on the eve of the Fed's move, this is that first 50 basis point cut. So on the eve here, we're looking for 100 basis points, give or take, for this year. We get the upshift to 50. Now we're at about 50 left right here. Then we get the upshift to a 25 basis point cut there. And now we're left, if we look at the monthly totals, about a 50-50 shot. But of course, if we do the math to get to the specific date in the second half of the month and we fine tune the probabilities that way, this is how we end up not so much at 50-50, but closer to 90-10 or 88-12. The more interesting bit is the bit for next year. If this is 100 basis points and the total is 233, it tells you that on the eve of the Fed's rate cut cycle, there was about 130 basis points expected for next year. That's been cut in half. Now the market only sees about 60 basis points for next year. And much of that has come as U.S. economic data was improving increasingly relative to forecasts. Again, signaling that what the Fed is doing in offering up all this stimulus is going to boost inflation. That it's going to give a situation where you're cutting rates and the economy isn't cold. As a matter of fact, it's quite hot. And what this will mean is it will dilute the Fed's ability to cut rates later downwind. And here's that reaction. Here's September. We can see it once the Fed gets done with what it's doing and the markets digest it for a bit. The dollar starts marching higher. Yields start marching higher across the curve, both the front end and the long end. These are the 10 and 2-year yields here. This is the dollar index. The yellow bars here are the slope of the yield curve. And up here are inflation expectations as measured by so-called break-even rates. These are the difference between nominal and real yields. If you take the difference, of course, it gives you that inflation adjustment that's implied in getting from nominal to real rates. Real rates are adjusted for inflation. So what you see here is inflation expectations rising as you get this better than expected data and, of course, a dovish Fed. Now, from here, the question then becomes, well, is there more adjusting to do? Is this stickiness in the inflation numbers really going to get the markets to go, you know what, maybe fine, we're on autopilot for this month, but next year it's not 60, it's 50. It's 40 or something of that sort. Well, again, going back to the minutes here, this emphasis on avoiding short-termism and looking through volatility in the data suggests that unless the numbers are wildly away from expectations, that's probably not anything the Fed is going to immediately consider to power a change in course. And as we can see here, while data was outperforming until about mid-November, since then it's made a turn and has started to cool a bit. Not so much the strength of the economy, no, but the performance of data outcomes relative to forecasts. It started to normalize back in the direction of where the forecasts sit, ostensibly because after these months of outperformance, analysts powering those models started to turn the dials because the models were obviously wrong and they had to readjust them to more accurately reflect actual reality. So now that seems to be having some effect, and data outcomes are starting to normalize back down to where forecasts generally sit. In the logic of this index, that's 0. So if that's occurring, then it is unlikely that the data shoots into some weird direction away from forecasts. As a matter of fact, if we look at the way that it's performed against what is probably the most closely watched model of U.S. inflation, the Cleveland Fed's model, we can see that there was a bit of a departure in September where the data ended up looking hotter than the model would suggest, but we locked right back in for both headline CPI, that's up here, the model is the yellow, and down here for core, the model is the green. We can see that both core and headline registered almost perfectly in line. A little bit heavier on headline, a little bit lighter on core, but very close to forecasts. So the likelihood that there is a surprise seems relatively low. So what then are we to make of this? We get economic data. It is important economic data. It is a closely watched bit of economic data. And it probably doesn't change the Fed's intent to move on rates next week. And unless it is a necessarily improbable swing that is some sort of a wild deviation from forecasts, which seems to look unlikely, we're probably not going to get a meaningful change in next year's outlook, at least until the Fed actually gives us an updated SEP. And that's next week. So what happens in the interim? Seems likely that we go back to this. These pullbacks right here, they don't reflect a change in narrative. They reflect the ebbing of speculative appetite in this reflation narrative. At some point, the markets seemingly have judged, well, you know what? That story that we had going for nearly 3 months, where the Fed is cutting and the economy is hot, coupled, of course, with the inflationary interpretations of the US election outcome, all of those things are in the price. And if you're a tactical sort of trader, there isn't much to do at that point. So maybe you take your money off the table. And so we've seen a pullback in the dollar, a pullback in yields. Inflation expectations have anchored. It is certainly not lost and shouldn't be that this is exactly the time that U.S. economic data started to normalize back down. So the thing powering this reflation narrative idea turned a corner. If that continues and is endorsed by the CPI data, we likely get another bout of US dollar weakness. We likely get another bout of lower yields and stronger bonds. And then, of course, comes the question of stock markets. Will they finally care? They haven't so far. They haven't participated in this correction so far. Maybe this gives them that license. We, of course, have to wait and see. Nothing actionable says they necessarily will or won't. But if there is an absence of speculative juice that's been pulled out of currencies and bonds, it is certainly not a stretch to say that that speculative juice can start to get pulled out of stocks, not because the trend has changed or the longer-term uplift factors have gone away, but because we've had a tremendously buoyant year for Wall Street. And what this data does, if anything, is give some of the tactical buyers nearer term a bit of license to say, I'm going to take my money and go home for the rest of the year. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour, Mondays and Fridays, on with Victor Jones for the Price of Truth tomorrow. Join us there for a full 90-minute show. We're going to probably debate the many aspects of crypto once again. Back with Victor for the First Call show with Tom on Sundays, writing for the news and insights portion of tastylive.com and opining on the platform formerly known as Twitter, as well as now on Blue Sky at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow.